Today is Monday, June 19th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research here at ADMIS, and Alan Bush, the Senior Financial Economist. Alan, last Wednesday, the Federal Open Market Committee decided to raise interest rates by 25 basis points, which is its fourth increase since December of 2015. When is the next Fed funds rate hike likely to take place by the Fed?
Well, right now, financial futures markets are predicting there's just a 50% chance that they'll raise again at the December meeting. The work that I'm doing suggests that it may be a little bit less than that, but in any event, they'll either raise in December or at one of the subsequent meetings in 2018, but rates are headed higher. And I really don't think it's that important when the Fed actually raises rates, but short-term rates are likely to continue to advance at least some measured pace.
The U.S. dollar index could only rally for one day after the Fed raised rates last week. Why was there such a limited bullish response to what is normally bullish news?
Well, this has been a pattern all year long. Basically, the dollar has underperformed the news. So while it looks like the Fed is going to continue to raise rates at some measured pace, other central banks are becoming less accommodative, and even the Bank of England last week became a bit more hawkish in their comments after their policy meeting. So it's interest rate differentials that are beginning to turn against the dollar index. So we would expect the dollar to underperform probably through the rest of this year. Any rallies in the dollar, I think, should be used as selling opportunities, and any breaks that we see in euro currency should be used as an opportunity to trade from the long side.
Interest rate increases from the Fed are usually associated with lower prices for stock index futures. Why did the Dow Jones futures advance to new historical highs last week and also today after the FOMC hiked its Fed funds rate?
Well, simply because rates are still low enough to sustain the bull market, even with the rate increase from last week, and with the predicted rate increases possibly this year or early next year. So nothing has really changed. The bull market, I think, will continue. And in fact, our work suggests that we will see higher prices all of this year in all of the indices. How high? I have no idea, just higher. So continue to trade all the indices from the long side. There's a lot left time-wise.
Steve, on Friday, the grain markets were looking for the Midwest to get some weekend rain, but indicated the next 2 weeks could be warm and dry. What does it look like now?
Well, it's ever-changing as far as weather is concerned. They were expecting maybe 70% of the Midwest to get somewhere between 1/2 and 2 inches, and that's pretty much what we got, especially from eastern Iowa eastwardly. The maps now look like they're going to be cool for the next 2 weeks. Each progressive 6-hour maps are a little drier than the previous ones, so it's very hard this time of year for the market to figure out how to trade a cool, dry forecast. But in general, it was a better forecast than what we thought on Friday.
Soybean and wheat prices are up today, corn is down. What's going on?
I think the corn market is relaxing and saying that we'll probably make a good crop with this type of weather forecast. For the beans, there's some talk that the Chinese are going to come in and buy some beans, which will help the demand. And then we haven't made the soybean crop. Like Central Illinois farmers say, my cornfield looks great, but right next to it, my soybean field looks sick. So, and in the wheat, we continue to see upticks in prices because of the dryness that we've seen so far, not only in the North Dakota spring wheat areas, but also parts of Europe and Ukraine.
Wheat, poor quality? Are there quality issues with the wheat?
There definitely is quality issues in the wheat. Hard red runner wheat protein is going to average maybe 1 to 1.5% lower than normal. So if I'm a baker and I want that lift for the bread, I'm going to have to buy some spring wheat to mix with it. So that adds a little bit more premium to the spring wheat market. So far, we haven't really got into the soft red runner wheat harvest yet, so it doesn't look like there's a lot of diseases. But in general, the lower hard wheat protein crop is adding to the basis levels.
Would you go over the latest USDA estimates for acres and also for supply demand for both the 2016-17 crop and the early estimates for the 17-18 crops?
Well, historically, we can go back the last 10 years, and during USDA reports, the trade range for corn, beans, and wheat is wider than any other given day. So the June 30th is when the USDA comes out with their latest revision. Prior to last week, the market thought that the farmers would plant less corn and spring wheat acres and more beans because of the wet spring in the Midwest and the dry spring up in the spring wheat areas. But we had a private estimate come out last week. It basically had the acres unchanged. So if it's unchanged, it might be a little friendly to the beans and maybe a little negative to the corn. On the 16 and 17 corn and soybean and wheat supply and demands, for beans they're probably adding a little demand, which will bring the carryout down a little bit. Corn and wheat will probably be unchanged. For 17 and 18, it's up to the yield. And people are beginning to bring the corn yield down, which could tighten the carryout a little bit. We still look to have sufficient soybean carryout at this time, and the wheat carryout is getting smaller. So from a 17 and 18 perspective, US-wise, corn and wheat's getting a little tighter, which could be supportive, while beans continue to be loose, which could be a little bit negative.
There's talk that the Chinese government is ready to loosen regulation on credit, restore the bond market for municipal financing, and inject liquidity to offset the real rise in interest rates. In a separate comment, the CSRC said it will support wealth management investment into commodities to boost the percentage of investment into portfolios, which may begin to further stimulate their economy. What impact could this have on commodity prices?
I think for the last, let's say, year and a half, the policy of the Chinese has been to lower their reserve stocks. And I think that there may be in certain instances, let's say in the energy market, in which they've got them low enough, prices have dropped low enough, and where the currency situation is, they may begin to start, as a policy, to increase their reserves again. And so that should be positive to commodity prices when they step in and start adding to the reserves.
Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.